Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 335 on August the 9th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on SoundHound AI Inc., Newmont Corporation, and the iShares Trust 20-plus year Treasury Bond ETF. And we discuss three new trades on Aurora Cannabis, GameStop Corporation, and General Motors. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the markets managed to end this volatile week largely unchanged. The Dow Jones Industrial Average lost 239 points, closing at 39,497 points on Friday. The S&P 500 index lost 2 points, ending the week at 5,344 points. And now it's time for the topic of the week. The topic of the week this week is trading what you see. Have you ever been in a situation where you thought you saw something? Or sometimes we are so used to seeing a certain thing happen that we just expect it to happen even when it doesn't. It's like our minds are jumping to a conclusion that doesn't actually happen. It just isn't real. When I'm trading during the day, I have to focus my mind on seeing only what's actually happening in the market at that point. Sometimes I can see the pivot point and the reversal. I then put on the perfect trade to capture that new move, only to lose money. I've had to teach myself to trade what is there, not what I think is coming. The author of the Dune book series had an amazing quote in his first book: "Hope clouds observation." Hoping for a move to happen, whether it's a continuation of the previous move or a reversal to a new move, can cost you money. The less I hope, the better I see. Those of you who actively trade, like if you're active in the markets, you probably know exactly what I'm talking about right now. Hopefully this helps you out a little bit. Rather than hope, design trades for what is actually happening and see if your profits improve the way mine have. So that's it for the topic of the week this week. Let's go ahead and get into the review of last week's trades. We'll start off with our covered call on SoundHound AI Inc. Symbol S as in Sierra, O as in Oscar, U as in Uniform, N as in November. At the time, the stock was trading for $4.63 per share. I looked at buying stock and selling the August 5 call at 30 cents, hoping for a 14.47% return in 2 weeks. Well, shares of SoundHound AI finished the week 24 cents higher at $4.87 per share. The call option we sold lost 5 cents, leaving us with a 29-cent gain if we were to close the trade out immediately. Now, with the stock staying above our break-even point at this point, we know there's no reason to close this trade out immediately. The options expire in a week, and if the price is above $5 per share, we'll lock in our full return of 14% in 2 weeks. Not too bad. If the shares end up staying below $5 per share, the option's going to expire worthless. We get to keep the stock, and then we can look to sell the $5 strike in September. And that call option is currently bid for 50 cents, which would just increase our returns. So even though it would extend the timeline for the trade if you held onto that stock, our total profit would grow significantly. I mean, there are worse things that could happen than increasing our profit significantly, right? So for now, no adjustments are needed. Just keep an eye out on the stock as we approach expiration this upcoming Friday and have a game plan for what's next. Nice trade so far. Next up, we have the credit spread on Newmont Corporation, symbol N as in November, E as in Echo, M as in Mike. At the time, the stock was trading for $48.50 per share. I looked at selling the August 47.5 put spread at 15 cents. That could give us a maximum possible loss of 35 cents per spread. Well, shares of Newmont lost 79 cents, ending the week at $47.71 per share. That out of the money put spread that we sold is currently at the money, which means we are losing some money on it. The stock price is 14 cents below the break-even point, justifying an adjustment. Typically, I would look to sell a call spread against this put spread to create a short iron condor. Unfortunately, the higher strike call spreads are not very valuable, certainly not valuable enough to make it even marginally interesting for me to create that trade. Instead, I would look to pay 19 cents for the August 47.5 put spread, thus closing the trade at a loss of 4 cents. I would then sell the August 46.5 put spread at 11 cents. It's a 1 week trade. This would cover our loss for the week and move our break-even point down to $46.89 per share on that spread. It does increase our maximum possible loss, but it's only for 1 week. If you don't like that, you could simply close the trade and take the 4-cent loss, or keep the original trade and keep an eye out on the stock move over this next week. There are lots of possibilities when you're trading options, and that's part of what I want to get over to you, those of you who listen to this show. It's never a this is right, that is wrong scenario. It's more, what is your current position? What's your capital position like? And let's try to optimize both of those so that you can, maximize profit and minimize loss. So it always depends also on your own comfort with the different risk levels. A lot of times my mental state has to be good for me. It has to be clear for me to make my next trade. I've actually closed a trade that was only slightly profitable just so that I could free up the mental space and put on an even more profitable trade. That's happened to me before. It's happened multiple times. Sometimes I look back and wish I had kept the trade on, but ultimately I typically am moving into something better. So it's just understand what's there. Always do the math so that you fully understand the risk of what you're about to put on and what you're about to adjust to, and then just go for it. All right. Final trade from last week was a debit spread on the iShares Trust 20-plus year Treasury Bond ETF, symbol T as in Tango, L as in Lima, T as in Tango. At the time, the stock was trading for $98.28 per share. I looked at buying the August 97.5, 98 call spread for 29 cents, which could give us a maximum gain of 21 cents, or that would have been a 72.41% return in 2 weeks. Well, shares of TLT ETF lost $2.02, ending the week at $96.26 per share. The in-the-money call spread that we bought is now out of the money, which also means this one is a loss for us on the week too. In fact, this current stock price is more than $1.50 below the break-even point. That means we can change things up a little bit if you'd like. You can collect 17 cents from selling the August 97.5, 98.5 call spread. You would be left with a short August 98, 98.5 call spread, which is out of the money. You'll recoup most of the loss on the week, and the price is far enough out of the money that you should have some room before needing to adjust this trade. Again, these trades expire this week. Now, if you want to be even more aggressive, and some of you are, you can sell the August 97, 98 call spread at 24 cents. This will definitely cover all of the losses from this last week, and this trade expires, of course, on Friday. However, it is slightly riskier than the previous adjustment because the short strike is only 74 cents out of the money. So it just depends on how close to the edge you want to live. The reason I can be somewhat nonchalant on which choice is because in either situation, we're still using a spread. So the risk truly is limited and your gain is known up front, right? Your gains are known and your maximum loss is known. Sometimes it's worth taking a little more risk to give a better chance for a profit. It just really ultimately depends on your own individual risk tolerance. So get to know yourself. And what's funny is you won't really know your own risk tolerance until you are actually trading your own capital. If you are paper trading, you might think that you're willing to take a $50 loss. Some of you find out that you're not willing to do it. Some of you are willing to take a $5,000 loss and feel like, yeah, I learned something that was good. It depends on how much money you've got and how comfortable you are with risk. So be true to your own risk tolerance. And if you don't know what it is, make a small trade. Hopefully it makes money. If it loses money, get a sense of how that makes you feel, right? If you cry over a $5 loss, doesn't mean that option trading isn't your gig. It does mean that you need to make sure that you keep trades on that can match your risk tolerance and not leave you with sleepless nights. And trust me, we used to call these, when I was on the floor, we used to call them trading mares. It's like a nightmare where it's all about trading. And I'll never forget a situation where I was trading a biotech stock that had an FDA decision on options expiration. I mean, how much more unlucky could you get? So right up until the end of the day, everyone's trading based on what they think is going to happen to this stock. And I was hedged with some stock. I also had some options on that were expiring. So if I took the options off, like without the options, I had no reason to be in the stock. The options justified my owning the stock. If the FDA decision went poorly, then even though my options didn't finish in the money, the stock that I owned would cost me way more than I was going to make on that option trade. So trust me, I've ended up in some hairy situations that lead to a sleepless night and an early morning the next morning where you're digging through your position to make sure you understand what's going on. I don't wish that for any of you guys. When I was doing that, I had a pretty nice salary that I was being paid, and I had a team of other traders to help me make big decisions, right? If you're trading from home, do not put yourself in that level of risk. Don't put yourself in that situation. It's probably not even worth it. So get to know yourself, get to know your own risk tolerance, all right? So that's it for the review of last week's trades. August expiration is only 5 business days away on August the 16th. All new trades on today's show are going to use the September 20th expiration for monthly options in September. So let's go ahead and get it going. We're going to start off with our covered call on Aurora Cannabis. Symbol A as in Alpha, C as in Charlie, B as in Bravo. The stock ended the week at $6.46 per share. I looked at buying stock and selling the September 7 call at 47 cents, hoping for a return of 15.63% in 6 weeks. You enter this trade by buying stock for $6.46 per share and selling the September 7 call at 47 cents. This trade makes the most money if stock prices finish above $7 per share. The break-even price on this trade is $5.99 per share. In real terms, the stock purchase will require $646 and you'll collect $47 for selling the option. Next up, we have our credit spread on GameStop Corporation. Symbol G as in golf, M as in Mike, E as in Echo. The stock ended the week at $21.94 per share. I'm looking at selling the September 21/20 put spread at 38 cents. That could give us a maximum possible loss of 62 cents per spread. Now you enter this trade by selling the September 21 put at $2.13 and concurrently buying the September 20 put for $1.75. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $21 per share. The break-even price on this trade is $20.62 per share. In real terms, you'll receive $38 per spread that you sell and have $62 at risk. And then our final trade on the week is going to be a debit spread on General Motors, symbol G as in golf, M as in Mike. The stock ended the week at $43.47 per share. I'm looking at buying the September 42/43 call spread for 66 cents. That could give us a maximum gain of 34 cents, or that's a 51.52% return in 6 weeks. Now you enter this trade by buying the September 42 call for $2.70 and concurrently selling the September 43 call at $2.04. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $43 per share. The break-even price on this one is $42.66 per share. In real terms, you'll pay $66 to enter the spread, and your maximum gain is $34 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for sharing as well. And you know what? Honestly, it's summertime. Things have been a little less volatile. Well, that is at least until the last 5 days or so. But thank you guys for listening through the summer. I get a kick out of the emails. I love seeing the numbers that you guys listen. And you keep this from being a lonely journey because I know you're right there with me. So, hey, I look forward to sharing a little bit more with you next week. Until then, have a wonderful weekend. Have an amazing expiration week. There's lots of opportunities during expiration. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.